Hey, welcome everybody to the 40 Finance channel. Well, Target dropped a potential recession bomb today when they came out and said that they are concerned about their profit margins going forward. This after just having an earnings report 2 or 3 weeks ago. And they go on to say that they're going to put massive amounts of inventory on clearance pricing. Now, any headline like this during the summer of 2022 is obviously going to be used to push the recession narrative that is supposedly coming to the stock market. So with Target, you have one of the nation's biggest retailers, and you could make the argument on the margin pressures and the clearance pressures that, hey, America is just not buying goods like they used to, and this is, of course, a key sign of a recession. Now, in this video, we're going to take this headline and maybe challenge it a little bit and see how it might impact other retailers, both similar to Target and, of course, stocks that are not so similar to Target, and try to figure out what does this news mean across the broader stock market. First, let's learn a little bit more about this headline from the Seeking Alpha news desk. By the way, if you're interested in learning more about Seeking Alpha, get yourself a free trial and 50% off of the annual rate. My affiliate link is in the description. If you follow the channel, you know I use Seeking Alpha all the time. But let's get into Target here. So Target Corporation announced a set of actions to right-size its inventory for the balance of year and create additional flexibility. The retailer expects to take additional markdowns to remove excess inventory and cancel some of their orders for shipments coming in. All right, so when you mark down products, right, and potentially cancel orders, that certainly has an effect on your profit margin. Target now sees operating margin rate falling to a range of around 2% for Q2 versus 6.5% consensus, before eventually jumping back to around 6% for the back half of the year. All right, so that's important to note, right? This is not a full year guidance change. This is a temporary clearance of excess inventory that will, in fact, impact the margin rate. But the goal here that's not talked about very much is to jump back to around 6% operating margin for the back half of the year. Now, despite that sort of positive sentiment towards the back half of the year, shares of Target fell 9.2% pre-market on Tuesday to $145.28. Price right now is $154.24 as I'm making this video. Take a look at this miniature sort of 1 year chart, and you can see that Target was at $235 at this time last year. Today at $154. Okay, now clicking over to Walmart, which actually got impacted by this news, sort of guilty by association, and Walmart's down approximately 2% today. And when you look at the 1 year chart on Walmart, it's actually down over the past year, minus 13%, year to date, minus 15%. But isn't this supposed to be, Walmart in particular, but I'd throw Target in there as well, isn't this supposed to be one of the solid locks in the stock market now as we enter recession? Isn't people packing things up and just buying, canned goods and loaves of bread supposed to be the new normal in a world of recession? Well, why are these stocks down then? Now, even beyond retail names like Walmart, we also had another surprise entry into the margin pressure game, and that is Cracker Barrel. And they came out and said that they are having a challenging macro environment, including deteriorating consumer sentiment and high inflationary pressures impacted both our top and bottom lines in the third quarter. However, the company's comparable store restaurant sales increased 11%, while its store retail sales rose almost 10%. So double-digit sales increases, but the costs of operating the business are increasing, which drag down some of their margins. The company said it expects operating margins, which are a key profitability metric for retailers, to be adversely impacted by commodity, wage and other operating expenses inflation. So bottom line, Cracker Barrel is struggling with profit margins as well. Now, what is interesting about these three companies so far, and they are relatively low profit margin companies. If we go to another segment of the restaurant industry, Dave & Buster's drives higher on strong sales and return to pre-pandemic traffic. Okay, so demand looks very well there, and they actually posted GAAP EPS of $1.35 above the bar set by Wall Street by almost 19 cents. Meanwhile, 70% revenue growth to $451 million moved past estimates by $10 million. Comp sales were considered a bright spot, jumping 10.9% compared with the same period in pre-pandemic 2019. So at least early on here in the recession talk, Dave & Buster's is doing well, and they actually grew 11% compared with the same period in pre-pandemic times. Funny enough, that's right in line with what Cracker Barrel described, the sort of 10% sales growth from a comparable standpoint. All right, so how did Dave & Buster's pull off this positive despite the fact that Cracker Barrel and Target are seemingly facing profit margin concerns? The answer to that is down here. Management voiced confidence that a leaner operating model can offset inflationary impacts and protect margins moving forward. And I look at that sentence there with the leaner operating model as a sign of which companies are going to do well, whether we get an official recession or just a pullback, which companies are really going to do well here. And I think it makes sense that it's going to be the ones who adopt the leaner operating model if they have a low margin business, which retail and restaurants are the kings of low margin business, or if you want to start thinking about companies that have a much higher profit margin model, then you'd have to start thinking about the tech stocks. And obviously tech stocks are sort of taboo right now. You guys know I'm a huge NASDAQ fan, and it's not getting any love. But let's take a look on what the difference is when you start talking about profit margins across tech versus, let's say, retail. Okay, so here's the top holdings in the QQQ. I've shared this screener before. This is just all the top names in the QQQ. We're going to sort by profit margin. You see who stands up at top, and look at these numbers. 88% profit margin for Adobe. All right, so Adobe definitely leading the pack, but let's be fair. If you had a lemonade stand and its name was Google, profit margin of 57%, isn't too bad a return on your money either. Now, who's at the bottom of the top holdings in the QQQ? Well, it's Costco. Costco, of course, is another retail store. Profit margin, hey, not bad at 12.4%, particularly when you're playing in the volume game, right? So that every customer that comes to Costco, spends hundreds of dollars, and 12% of that is nothing to laugh at. But when you compare it to the tech sector across the board, even Amazon, which to be fair makes most of their profit margin from AWS, but at the end of the day, 42% total profit margin compared to Costco's 12.4%, if we do indeed start to see these recession fears become a harsh reality, I would much rather be at a profit margin of 42% versus a profit margin of 12% if recession and inflation are going to be digging further into our profit margins. All right, now bottom line here, I think there's a few things you can walk away with from this particular video. Number one, as we look through the Target headline versus the meat of the article, yes, profit margins are going from 6% down to 2% in some categories. However, they do expect to return back once they sort of call off this excess inventory. So the obvious point there is don't just read a single headline and assume a recession is coming for the United States. Okay, point number 2, we sort of compared Cracker Barrel with Dave & Buster's, and we saw two different sides of essentially the same story, right? We saw plus 10% sales comps for both of those. The difference is that Dave & Buster's seemed pretty proud about their leaner operating model that was going to protect margins, whereas Cracker Barrel was basically saying consumer sentiment, cost of goods, wages was going to put pressure on them for the rest of the year. In my opinion, those two businesses are being managed differently, and those are some of the things you have to look out for when these inflation costs start to creep up. And then last point, of course, as the QQQ King, I had to take in my little shot there on the difference between margins in the tech industry as well as growth and demand versus something like a Walmart and Target, who many people would say are great recession stocks, right? But you start to look at it and you start to think about the long term. If you want to look at companies that are literally printing money and profits, I think you got to start looking into the QQQ stocks that have come down as opposed to getting into a high point on, let's say, an oil stock that historically has never produced profit margins as high as they are right now. All right, hope you enjoyed this video. Don't forget to check out that Seeking Alpha special offer in the description below. Hope everybody's doing good. We will see you on the next video.